Welcome to this episode of the Bear Ventures podcast, where we open the book on venture capital and give you a seat at the table. My name is Samir Vig, and I'll be your host today. And joining me is longtime friend and brother, Apoorva Pandhi from Foundation Capital. How are you doing, my man?
Doing well, Samir. Good to be on the same podcast as you.
Yeah, we're long overdue for this, so I'm glad we're able to make this happen. I feel like I call you every week, talk about a deal anyways, so now we get to at least record it.
Absolutely, looking forward to it.
Awesome. Well, for those of you who don't know Apoorva, he's a partner at Foundation and has a specialty in enterprise investing and looks at many companies in the modern data stack. So before I butcher his background, I'll let him jump into a bit about himself, Foundation Capital, and then we can go from there.
I think you've covered everything, but let me give you a little more flavor.
Okay.
Maybe let me start with Foundation itself. Foundation, for all those who don't know, is a 25-year-old venture fund. We're currently investing out of our 10th fund, so we've survived so many funds. Must be doing something right. It's a $500 million fund where the first check is anywhere between seed to Series B. Also have an opportunity fund for doubling down on existing portfolio companies for their future rounds. I spend most of my time looking at the enterprise space, although the broader team at Foundation also looks at fintech with flavors of crypto. And we've also made investments in consumer startups as well, which have now scaled. A lot of common household names like companies like Netflix, Chegg, Clubhouse being few of them. On the enterprise side, a lot of known names as well, companies like MobileIron, Cohesity, ForgeRock, to deep AI chip companies like Cerebras and GraphCore. And within the enterprise stack, my sweet spot is all products and technologies that interface with the technical audience, which include data scientists, developers, ML and AI practitioners, enterprise IT. I do make exceptions and invest in other parts of the stack as well, things that kind of resonate with me and is relatable to my previous experiences. Those include things in the RevOps part of the stack, which include sales ops, customer ops, marketing ops, and that category. And then I also look at things in the automation space, which are more horizontal, which could be applicable to any industry. Also spend some time in the healthcare space, given that I've built a business in that category. So that's a quick background of the fund and my focus in the fund. This is my second stint in venture. Used to be at Lightspeed Ventures almost a decade back, where again, I focused on enterprise and some bit of consumer as well. I'm an engineer by training, and I've spent the last decade or so being an operator. So founded my own company at the intersection of NLP and machine learning called Funnel Labs. And then after that, chose to focus on the go-to-market side of things, where I've led sales and customer success teams across a bunch of companies. And that was mostly because I loved understanding what customer needs are and feed that back into both the go-to-market motion as well as what the product needs were for those particular customers and companies. The role right before Foundation was at a growth stage company called Quid, which I helped scale before its and after its acquisition, I came full circle back to venture. So that's a quick summary.
Yeah, no, you've certainly aged yourself, but we won't do the math here. So you've been a founder, you've worked as an operator, 2 stints in venture. A lot of what you do now is working with early stage companies, getting board involvement, and really trying to be a value add. And I think that's one of the big differentiators of what we've talked about in the past. I'd love to learn more about, for the earlier stage companies you work with, what it means.
Yeah, I think when I was thinking of coming back to venture, one of the things that I was really looking closely at was what kind of venture firm do I want to go back to? And I think one of the things that stood out about Foundation was that most of the partners come from operating backgrounds like me. And we don't want to invest in early stage for optionality or for exiting too early. If we are investing early on, it's really for the long haul. And we really want to work closely with those portfolio companies. And the way we help them is in multiple ways. One is really leveraging the experiences that we've had, help them from that particular functional point of view. So for example, if I'm coming from a sales background, I'll help my portfolio companies figure out what their go-to-market strategy should look like, what the playbook for hiring the right kind of talent should be. Because a lot of startups are reinventing the wheel for just understanding like what the basic customer funnel should look like, what kind of talent is needed for different stages. So that's one piece of it. But the other piece is also, since I literally used to sell to a similar audience before, I've cultivated a good network of potential customers that these companies could sell to. And there are other partners at Foundation who have their own customer networks. And we also have a centralized network of customers at Foundation. It's called Compass, where we have leaders of from engineering, data engineering, enterprise IT, security, and all those different functions as well. So one of the big value adds is to introduce the portfolio companies to customers directly, so that these companies are so early that they want feedback from the practitioners and end users. And secondly, if they like the product, a lot of our networks have also purchased or bought or become buyers of these products as well. So hopefully we can say that it's not just like providing capital to these companies, but also helping them sell eventually, is kind of one unique kind of value add that we provide. Apart from that, I think I would say from a talent perspective, from a future financing perspective, like every investor tries to help on those fronts. When we put our best foot forward over there as well, we have recently hired a talent partner who used to lead executive recruiting at Slack to help our portfolio companies with linking them up with the right kind of external talent partners, as well as also like running searches himself wherever needed. And we can draw from our own networks as well, especially like a lot of these companies need help in marketing hires, in UI, UX hires, and so on. That's where we get personally involved and introduce them to people that we worked with before. So that's how I would say that we are really helping them as closely as possible, and it's not a passive investment for us.
Yeah, and I think that's very well put. A founder once told me that money always spends the same, and then asked me what else I can do. And I think you hit a nail on the head. And that's one of the key differentiators of folks like yourself. And so when you think through, such a deep level of involvement in so many companies, one of the questions that a lot of early stage founders will have is there enough attention, if I'm a seed stage founder, for example, that I will get from my company as I look to scale? How do you balance that internally?
Yeah, and I think that also goes back to like how many investments do we like to make in a year? Since we are spending so much time with every company, we don't want to make too many investments per partner per year. So they end up being around 3 to 5 investments per partner per year. And we try to have a healthy mix of seeds as well as A's in that particular portfolio. Obviously, depends on if those A's are at the right valuation for you to win. But we like to maintain that right balance in our portfolio and not too many investments per partner per year. And seeds also range, right? There are different kinds of seeds that you do. There are cold start seeds where people don't have a product, but you're investing in founders and the right market opportunities. And we've done a bunch of those. There are seeds where the tool is, or the framework is open source or is freemium and is being used by multiple users. And you have some evidence that like people need something like that, but the commercial product around that hasn't been figured out. So that's another kind of seed. And third category of seed is you've built the product, you've assessed customer need, but you haven't launched it yet. And that's still pre-revenue. And there's a spectrum of all these different kinds of companies that we're looking at. And every company needs different kind of support. So it's important for us to kind of maintain a healthy balance of the companies that we are investing in, as well as not investing in too many of them, so that we can give equal bandwidth or good bandwidth to each of these companies.
Yeah, and in one of your answers, you mentioned not investing for optionality. Now, yeah, for those of the folks listening that might not know what that means, what do you see happening in the market, and where did that really come from?
So that statement came mostly from I think your recent question, right? How much bandwidth do you provide to your companies. Optionality being that if I would be investing in early stage or seed stage for optionality, then I would just be making a financial bet and seeing that, like, if any of these graduate to the next level or any of these have garnered that velocity for the next round, then I'll double down, and then I'll help them and support them in any way possible. I don't think that's the approach that we want to take, because when we invest early on, or at least when I invest early on, looking at it from a thesis perspective, that this is where the need in the market is, and these are the founders who are well equipped to address that need. And so we have full confidence, or a lot of confidence in our conviction in what we are investing in. A lot of investors might, especially like growth stage investors that are investing very early on in today's market, they are taking a lot of shots on goal, and not sure of how much bandwidth they would have for each of the investments that they are making. And that's what I term as optionality, compared to like making fewer number of bets, having full conviction in those bets, and supporting them all the way through to liquidity. And I'd be lying if I would say that every company gets there. Like, few of the companies that you invest in make it, and a lot of them die for different reasons. And I think the true test of a good investor is if you would ask those companies that are no longer there or haven't been able to make it, or are still trying, how helpful the investor has been. And I think that would be a good testament to whether you're an investor there for optionality, or are you there for like really supporting the founders that you're investing in.
Yeah, it's a great point, and really should be a two-sided interview, right? When somebody pitches, they shouldn't just be pitching for money. They should be finding if that venture firm is the right fit, and really that partner in particular. But if you look at what you were talking about for optionality, I think it's interesting, as it used to be the case where there was a big spike in later stage rounds in terms of valuation. This optionality piece that you just mentioned is why I think we're seeing such a big spike in the earlier stage valuations as well.
Yeah.
And something that folks should keep an eye on. And so on that topic, and you alluded to this as well for the Series A's and beyond. What are you seeing in the market by way of what's happening with valuations, competition for rounds, and what is it taking to really other than pro rata rights get access to some of the best deal flow?
It's a great question, and I wish I had an answer to how to get access to the best deals at the right time. But as you know, and I know, that the market has been crazy during the pandemic. It was interesting, like as soon as the pandemic hit, there were a lot of investors who took a back seat, and like they were like watching how the market would evolve. And there were a few investors who continued to invest, and I think we continued to invest in that particular phase, and that helped to a large extent, because we got deals done we got good deals done at good prices. And then after that, the market completely changed, where in late 2020, the whole of 2021, the number of unicorns or decacorns that have been created are more than the last decade itself, or more than that. And that's just because there's been a lot of capital in the market, and whether it's early stage, like growth stage platforms, or even hedge funds, everyone is trying to go as upstream as possible. Everyone is trying to invest in seed rounds, Series A rounds, Series B rounds. That just makes it pretty hard for early stage investors to kind of differentiate, to kind of stand out, and to win deals. And I think now the market is starting to turn with how the public markets are behaving. So it's yet to be seen. I think the data points are still less, because whatever deals we are seeing right now are the deals that were being pursued in Q4 of last year, and they're getting the term sheets right now. And we've seen some correction in valuation, where the asks aren't ridiculous, but we're also seeing like a more disciplined approach amongst investors, where I think and hopefully that should be the case, and it'll help the companies, the founders, and the investing community in general, is having some discipline in investing in companies that have strong foundational elements, versus investing in something just based on hype, and based on like who the co-investors are. Because anything that has strong business fundamentals is likely to sustain longer, and is likely also not to get overvalued because the founders are being cognizant, especially in those companies and a lot of those companies, about growing into the valuations of the future rounds. I've had many thoughtful conversations with these founders, especially some companies that we are bullish about, that they want to get good valuations, but they don't want to get crazy valuations, so that once they achieve the next milestone, there's an uptick in valuation and they're growing into that valuation. So I feel the market is become slightly better, but I wouldn't say it's made a big difference on the early stage side yet, or it's yet to be seen how it impacts the early stage side.
Yeah, and where we are in this correction, it's still quite early. It's
Yeah.
not as large of a correction as one might think or maybe expect.
Right.
And, oftentimes the earlier impacts are on the very late growth rounds or the pre-IPO companies.
That's right.
How severe are you seeing that on the earlier stages? You think for the pre-seed seed companies, is it really having that much of an impact? And then what kind of impact, if you could put maybe some sort of a quantification around it on like the A rounds, for example, or the Bs?
Till now, till at least the last 2 years, there was no semblance of any alphabets. A's, B's, and C's, and even D's were all merging together. It didn't matter what revenue you had. It didn't matter where you were in that journey, how early or late you were. I think it just mattered that if it was a company that was in a space that everyone wanted to be in, and you were a founder that everyone wanted to invest in, it would get like a crazy markup in valuation. I think it's still early, as I said, to kind of talk about early stage seeds and A's. I don't have as many data points to suggest that how other investors might be considering those rounds. I think from our side, we've always been disciplined about like where to value the company. Like even in the market, even in a crazy market like last year, we did a lot of seeds, and there, not that there weren't many A's to do, but a lot of those A's were being done before the company had any metrics. Like some of those A's had like zero revenue, so might as well be a seed. But like those were being pursued like an A investment. And I think we have our rubric around investing in different rounds adjusts over time. It's not that it should remain the same, but it's also like what you feel is are the foundational elements for different stages. How much capital should the founder have at different stages so that the founder is disciplined and is achieving milestones and goals accordingly, is also something that should be considered by investors. And I think we've been cognizant of that. And that's why we've been both disciplined around the amount of capital as well as the valuations for different rounds, especially on the seed and Series A side, because that's kind of the core bread and butter. Although we've been also fortunate to see a lot of our portfolio companies IPO in the last or get acquired in the last 2 years. So we've had the benefit of seeing either end of the spectrum. And what really helps when you see such growth stage companies that are either IPOing or getting acquired is you see like what it takes, what kind of DNA does it take to kind of build those kind of companies, what kind of team it takes, what kind of metrics it takes, what kind of KPIs are needed internally. And we can like feed that back as foundational elements in our early stage companies. So while the appetite for valuations have changed just because there have been more decacons, like in the past, you could only see unicorns. And that's why you would always say that it's hard to value the company at a certain amount at this stage. But if there are no more number of decacons, and that's again based on where the market is, maybe the market changes tomorrow and the number of decacons also reduce in number, and they are likely to. But when there are more number of decacons being produced, you at the early stages, you're more flexible valuations because you feel that a company that you're bullish about could potentially be the next decacon. And then why miss out on a company like that just by worrying about like a couple of $1 million here and there? And that was the key thought behind being flexible on valuations in the early rounds, though I think on our side, we've been pretty disciplined about it.
Yeah, and I think that's been the general sentiment for a lot of the earlier stage founders or fund managers I've spoken to as well. And it's really about getting the conviction behind the right companies and placing your bets. And, you know, just based on where the environment is, you can't pass on everything. But if you believe strongly enough, then that's where you put it. And I appreciate you kind of walking us through, you know, the rubric you mentioned and the process internally. You know, another thing that we briefly discussed in the past about process is how things have changed over the last, you know, call it almost 2 years due to, you know, COVID and everyone being remote. You know, I'd love to hear more about how that's affected the way you guys look at companies, interact with companies, and think through your investments.
It's completely inverted the paradigm of investing, right? We always used to say that venture is a profession full of serendipity. You run into founders in elevators, at golf courses, at different places, and you have no clue who those people are, but they end up being like either a practitioner who wants to be a founder or an early stage founder that you never met before. But being remote changed everything, and everyone had to completely rethink how they should approach sourcing, how they should approach building relationships, how they should think about evaluating those companies, because you can't meet people in person, and a lot of conviction is built by meeting people in person. And that was the thought process before the pandemic. And we've made so many investments, I can't even count them, during the pandemic, that were completely remote, uh, fully on Zoom. From starting to finish, everything happened on Zoom. And I think the core questions for me was that, how do you differentiate yourself in terms of identifying those companies early on? Because if the entire market is moving early, then how do you identify things early on? But at the same time, it's not about only identifying deals early on, right? Because those could be super early in terms of product, in terms of everything else. So you definitely should make those bets as well. But how do you construct a healthy portfolio overall, where you're investing in something which is out in the market, already has some adoption, versus something that is starting out and is pretty upstream? So one is figuring out that healthy mix and like which vectors to attack to be able to identify those deals. Second is to build that relationship or the rapport with the founder, which in the past used to be meeting for lunches, coffee, drinks in person, just to get to know the founders, their body language, like how consistent or inconsistent they are in terms of how they're thinking about things over a period of time, had to be all done online. And that was interesting because it really pushed us hard to understand not just the founders, but the people that they work with, talking to more people in the team, talking to more number of people in terms of references on the founders, from the current job, from the previous jobs, and just getting a better understanding of the person themselves. And I think we put a lot of emphasis on that, because early stage is all about people, right? It's all about 60 to 70% of the investing decision is around the team, and what is the skill sets of the team, what is the passion of the team, what are their positives, and what are the areas that they can work on. I think we have to understand all of them in a more holistic way, which I think would compensate for meeting offline, and then closing the deal, because a lot of those deals might have been upstream, and you might have been the first few ones to meet that company. But then there are a lot of these other deals, since everyone was going upstream, were very competitive. So how do you win those deals in a remote first world? And so it's all about using like LinkedIn and Zoom and GitHub and Discord and Slack communities in the most creative way possible.
Yeah, no, you mentioned the serendipity of running into a founder. I think the other way to win the deal, as it used to be, is you'd plant yourself in that elevator or that golf course or coffee shop and magically run into them there, right?
Yeah.
But no, things have certainly changed. And you know, I'd be curious if you had any advice for founders who, you know, look, you've got the serial entrepreneurs who've got the network, and they can pick up the phone and call you, or you know, whoever else is in their network. You know, what would you say to those who don't have access to the events or the ability to run into somebody, or may not have the network to get a warm intro? You know, what is the best way to really go about meeting early stage investors like yourself?
I think since in today's market, and generally otherwise as well, if you want to be a good investor, the onus is on the investor to identify people. But I think if you flip it around and try and understand from a founder's psyche, I think it's less about knowing the investors or knowing people who know investors. It's about standing out. Like, how do you stand out uniquely? And there's so many different channels today to stand out uniquely. If you are good in your profession, in your area of focus, in the projects that you've done, then using different platforms to talk about it, to publish content. And the content can be published in so many channels now, whether it's Substack, whether it's Reddit, or whether like you can be an active member of a Slack community where your voice could be heard if you kind of truly are making difference in that particular field. And with all those different things, if you are consistently standing out in different channels, and again, different sectors and different categories and different verticals, there'll be different approaches to it. This kind of an approach, when I speak about like whether it's Reddit or Substack or any of those, works pretty well for developers, or like companies that are being built for developers, because a lot of those products and tools are adopted bottoms up. They're adopted by ICs first, or individual contributors first, and then you go and sell like a product to the organization or the team. Not that every product is like that, but a lot of them are like that. But and that's why if you're resonating with that community, that peer group, then you're standing out as a potential or a practitioner who could be a potential founder in the future. It's not just about like what brands have you been a part of, or what companies you've been a part of. It's about how thoughtful and how much resonance are you getting in these communities, and how much content are you publishing that people are reading. But then there are other verticals as well, right? You might ask me that, like, what if you're in healthcare or in RevOps and so on? And I feel like there are different platforms for each of them. Like for healthcare, there are conferences that are happening, that are still happening virtually. I know that Health happened last year as well, which is one of the biggest conferences in healthcare. I think just figuring out different platforms and conferences where people used to find deals and founders, as well as a lot of communities online that have become more front and center for investors to hang out in, to find and look for people. I think that's what I would suggest. I would just say, like, play to your strengths and not try and like stand out just for the investors, because the investors need to find people who are good in their respective fields and are deep in their focus areas, and are able to influence people. And I think if you can do all of that through your attributes, you'll definitely stand out for investors.
Yeah, no, I think that's helpful. And for those of you interested, I can tell you exactly where Apoorva hangs out. So you can run into him whenever you need to. And you know, one of the things that I'd love to do, you know, you mentioned a few of the industries you look at and a few verticals you've invested in. I'd love to take a look into the future, you know, not just the future of, you know, how do you view the firm evolving, but how do you view the industries that you're excited about evolving, and what are you looking at for not just the current fund, but future funds and beyond?
Yeah. So as I said, right, I spend a lot of my time with the technical audience. So I'll just pick one industry that I'm looking at very deeply, which is the data stack itself. This data stack is continuously evolving with, I think externally, you might just see like data coming into a company, whether it's structured, unstructured, whether it's in like SaaS apps or through your databases or through like operational sources. And then after that, there are outputs, which could be BI, business intelligence. It could be an application, or analytics, or it could be a machine learning model that could be powering an internal application or an external application. So those are the outputs and inputs that you see. But within that entire stack, right from where the data enters the company or is stored in any of the different platforms to where it's consumed as an end consumer, whether internal to the company or external to the company, there's so much complexity that's happening in that entire piece of the stack. And that entire stack has evolved a lot. Like the entire infra stack, whether I take software or data, which is a level, kind of a level deeper than software, always acts like a pendulum, right? It goes left and right and left. So right now it's in the position of a lot of fragmentation. There are tools in every possible subset of the stack. Like if I oversimplify it, there's obviously the data warehouse, which evolved in the form of whether it's the cloud data warehouses, Snowflake, and so on. But then there's also an evolution of the data lake itself. And both the warehouse and the data lake are good for their own reasons. But like, what should the end users do? And end users over here are not just technical users. The end consumers of data are the less technical consumers as well, whether they are PMs, whether they are analysts, whether they are data scientists. In fact, one fun fact, like more than like a majority of data scientists don't come from software engineering backgrounds, but they are expected to like build models based on a machine learning infrastructure. And that machine learning infrastructure is built by ML infra folks and ML platform folks. Same thing happens with analysts. They are expected to give you insights and hypotheses, but they don't own the entire data pipeline. The data pipeline is owned by data infra folks. And not every company can afford data infra and ML infra folks. And even if you afford data and ML infra folks, it's hard for them to kind of repeatedly do the same thing day in and day out, because they can do more productive things in the company to make the company move forward in a better direction. So how do you enable like these different personas so that they are not dealing with this fragmented state of the stack, but at the same time, they're achieving the end use cases, because that's what matters most to them, right? For a ops person or an analyst who's working in the marketing team or a sales team, they don't want to worry about which database are we using, which warehouse are we using, whether we are using Kafka or Flink or whatever. They just want to be able to like build everything themselves, or even or in the least friction possible way, and get insights out. And not just like dump insights. They want the insights to be hypothesized in a way that is already tested or A/B tested before it reaches the execs. And I'm talking about that future where that happens. Today, most of that doesn't even happen. So that's what I'm trying to look at. Like, how does that stack evolve? How do you empower the less technical as well as the technical users? Because it's not just empowering the less technical users, it's also hand-holding the technical users so that they are not bombarded with requests all the time for kind of doing the same thing or a hard thing as well. How can you give them services out of the box externally? And what can be done to kind of empower end users with powers of the data lake, which is pretty hard to use. And that's why a lot of things have been done in like closed source systems, whether it's Snowflake or Databricks, or even the cloud itself.
And I'm glad we've got smart folks like you to build the piping for all this, that end user piece that you mentioned, and some of you might have heard of the terms, low or no code, that's kind of where that really plugs in, the ability for somebody to access and use data the way they want it without the help of an army behind them. But no, it's certainly a space that I follow closely, that I call you about weekly, and look forward to seeing, versions 2, 3, 4, 5 and beyond of it. So it's exciting to watch. Well, Apoorva, it's been great to have you on. This is definitely the most serious conversation we've ever had, I think, in the time that we've known each other. But look forward to having you on in the future and kind of getting an update of what's going on. For those of you listening, I hope you enjoyed the show today. If you want to be updated of more future podcasts that come up, please follow myself, Samir Vig, on LinkedIn. You can follow Bear VC on LinkedIn as well, or check us out at www.bearevc.com. Until next time, take care all.
Thanks, Samir.